Are you a small business owner watching your profit margins disappear because of tariffs? While big brands like Nike and Apple are quietly gaming the system to dodge these same taxes, small importers are getting crushed by rates as high as 125%. But here's the thing, those same strategies that the big players are using, they're available to you too. And by the end of this video, I'll show you exactly how to use them. If you're importing goods right now, you're probably feeling the squeeze. Recent tariffs have hit everything from electronics to raw materials, and for small businesses, this isn't just an inconvenience. It can mean the difference between staying profitable and falling into the red. But while some small to medium-sized businesses are scrambling to stay in business, smart SMBs are turning these challenges into competitive advantages. Today, I'm going to show you the exact playbook that successful companies are using to navigate these tariffs and thrive. Let's start with a quick TLDR about tariffs. Tariffs are taxes on imported goods, and they're paid by the importing company. So if you're importing goods, that's you, not your supplier. Basically, here's what's happening. Importers and retailers are seeing immediate cost jumps due to these new tariffs. Manufacturers relying on global components are facing higher production costs, and exporters, they're getting hit with retaliatory tariffs from other countries. But here's what the big companies know that most small businesses don't. The impacts of tariffs, they aren't entirely unavoidable. There are still plenty of ways to soften the blow, and here's how. The first hack that I'm going to be talking about today is called tariff engineering, and it's exactly what it sounds like. It's designing your products to fall into lower tax categories. And this is nothing new. Big companies have been doing this for years. Take Marvel's Toy Biz, for example. They went to court in the early 2000s to get a tariff reclassification on their X-Men figurines. They argued that these were non-human toys rather than dolls. And in 2003, the courts agreed, which resulted in the tariff rates for those figurines going from 12% to 6.8%. This effectively saved Toy Biz millions in future import fees. Now, you might not be making toys, but the principle still applies everywhere. Work with a customs broker to review your HS codes. Sometimes a small design change, like adding a pocket, changing a material, or modifying packaging can move you into a completely different tariff category, which will save your business huge amounts of money in the long run. Hack number 2 is all about using bonded warehouses and free trade zones, and this one is huge. Basically, a bonded warehouse lets you store imported goods without paying tariffs until they're released into the domestic market. So this means that you can defer paying tariffs until the goods are actually needed, which improves your cash flow dramatically. But here's the kicker. If you re-export those goods directly from the bonded warehouses to another country, you might avoid paying tariffs entirely since they never entered the domestic market. Free trade zones, they work similarly, but they're even more useful for anyone that's doing light manufacturing or assembly because you can store your inventory there and only pay duty on the finished product once it enters the market. And sometimes that finished product has a lower tariff rate than the components, which saves you even more. Many third-party logistics providers offer bonded warehousing services and handle all of the paperwork. Using bonded warehouses and free trade zones essentially buys you time and flexibility. Now here's a hack that most businesses don't even know exists: duty drawback programs. If you re-export imported goods or products that include imported components, you can get a refund on the tariffs and import fees that you've already paid. For example, suppose that you import components with a 25% tariff. You use those components to then assemble an industrial machine, and then you export that machine overseas. You can often claim a refund for the tariffs that you've paid on the components already. The key here is to maintain thorough records of your imports and exports, and it actually may be wise to consult a customs broker or a duty drawback specialist to handle the filing. But when done right, the government will literally send you a check for up to 99% of tariffs that you've paid. Tariff relief isn't all about gaming the system. Sometimes a simple improvement in your demand forecasting can make all the difference. This is where inventory forecasting tools like StockTrim become invaluable. Their AI-powered forecasting helps you predict demand patterns and optimize your ordering schedule around tariff changes. So instead of panic buying or getting stuck with excess inventory, you can plan your imports strategically. So for example, if you know tariffs might increase, StockTrim can help you calculate exactly how much to front load without tying up too much cash in inventory. It takes into account your historical sales data, seasonal patterns, and lead times to give you precise recommendations. The key is having visibility into your future inventory needs so that you can make strategic decisions rather than reactive ones. Let's talk about the financial side. To start, there's the first sale rule. Instead of paying tariffs on your supplier's marked up price, you can often pay based on the original manufacturer's cost. This alone can cut your tariff bill in half. Next, optimize your cash flow by using customs payment programs. That lets you pay duties monthly instead of per shipment. And you can also consider consolidating shipments whenever possible. Every time that you import, you may be paying a fixed brokerage fee or a minimum duty, so fewer larger shipments means paying those fixed costs less often. Lastly, try to negotiate with your suppliers to share the tariff costs. Often they'd rather give you a discount than lose a long-term customer. This last hack is what ties everything together: bulletproof inventory management. Because all the tariff optimization in the world won't help you if you can't track your true costs and the flow of your inventory. When tariffs are constantly changing, you need real-time visibility into your actual costs of goods, including duties and fees. Many businesses are flying blind here, and it's killing their margins. This is where inventory management software like inFlow makes all the difference. It tracks the true landed costs of every item, including tariffs, so you know your real margins. You can manage multiple suppliers with different lead times and costs, which is crucial when you're diversifying your supply chain to avoid tariffs. inFlow also handles multi-location inventory, so if you're using bonded warehouses or free trade zones, you can track exactly where your inventory is at all times. Look, tariffs might not be going away anytime soon, but that doesn't mean that you have to just accept them as a cost of doing business. Whether it's reclassifying your products, using bonded warehouses, or improving your inventory management, you have options to help mitigate the impacts of tariffs. The companies that thrive in this environment, they aren't the ones with the deepest pockets. They're the ones with the smartest strategies, and now you have those strategies too. If you like this video, please leave us a like. Were there any strategies that we left out? Let us know in the comments. And if you like content like this that's going to help you optimize your business operations, make sure to subscribe.